Alrighty, good evening. Welcome to the Hurley Investments Market View Commentary for Monday, September 2nd. This is Labor Day weekend. Nice to see a small group here today. And let me just start off with where I wanted to go with the way that we trade. So let's just put it this way. Hurley Investments believes in the collar trading strategy. Why? Let me ask this group tonight, why do we believe in the collar trading strategy? Why do we believe in collar trading? And in case you don't know, a long stock position with a long put and a short call. Now, adjusting means when bullish, maybe just run the long stock position. If you're uncertain, maybe run a protective put. If it looks ugly, run all the positions in a mostly net neutral delta, meaning you make just as much as you would as it goes up or down. So, a couple good answers came in. Why do we belong in this? Because we make up the downside movement. So, I'm going to say yes, because we make up some of the downward movement, right? We don't always make up all of it, but because we make up some of the downward movement, it's active management. We're actively finding ways to make up some of that downward movement so you don't have to wait as long for the positions to come back. I almost want to say it's common sense, and it is. To a certain degree, it is common sense. But I'm not a passive person. I just don't let things happen to me. I try to predict and or prevent big downward drops. Second question, because you can pick up more stock. Yes, because we can dollar cost average without having you put more money into the account. I don't have to go and I don't have to bug people. I don't have to say, hey, we need more cash. Hey, Disney's down. What else is down? Under Armour's down. In fact, kind of a sad one, right? Under Armour just lost 35% of its value. So go put more money in your account so I can invest into a loser even more. Well, it's not a loser, and it's not. It's being affected with the Chinese tariffs. It's being affected dramatically. But yes, if I've got the right to sell Under Armour at $27.50 or $28 and it falls all the way down to 20, we picked up 30% more shares of stock in Under Armour. Really pretty amazing. If I can pull up a chart on Under Armour, we had a huge drop after great earnings. Nothing like making that $27.50 all the way down to right there. And then we added more $20 puts to make up to where we're at right now. This drop on 1,000 shares, this drop right here, we picked up 30% more shares of stock. And at no point did I have to go tell someone, hey, go stick like $6,000 more in your account, or 12,000 or 24,000. We made it up with that downward movement. There are a couple people that like Schlumberger. I just like saying the name. Maybe not one of my favorite stocks, but Schlumberger. Ugly looking chart. Thank goodness we had on like $40 or $42 long puts. Easily picked up 200 more shares of Schlumberger. Great opportunity in collar trading. If I can go ahead and just say it simple. Great opportunities to add more shares for the next run to the upside. Now, some people ask me, well, I always want to be protected. Well, if you always want to be protected on something like Apple, it would cost you about 18.6% of the value of the stock throughout the year. So Apple would have to move if you wanted to have a protective put, the right to sell the stock on all year long. It would cost 18.6% of the value of the stock to always have it protected. Which comes to another reason. Well, you can go out in time and you can short a call. You can cap it. You can roll it. There's a bunch of you could do's, but the main answer is this. I'm not too interested yet in capping my upward movement. We're coming off of a historic 10-year bull market run. So when we're coming off a 10-year historic bull market run, it would not have done me a lot of good to be capped in these last 10 years. Again, not only would I be losing that 18.6, and usually it's about 16% to 22%. If you're always protected every day of the year, you've got to have your stock move between 16.6 to about 22% till you break even. I don't feel like doing that. It's okay on a bullish stock to not have protection on. Why would you put a bearish position on a bullish stock? It doesn't make sense. Because we're coming off a historic bull run, we're about 6 years overdue for a correction. Well, let me take that back. We did have a correction for like a day. We dropped below 10%, but we haven't been in a bearish market. We haven't been in a true correction where it stays down 10 to 15%, maybe upwards 20%. We have had a correction, one day over 10% correction, didn't even finish in correction territory if I remember correctly. But because we're coming off a historic market bull run, our next bear market will most likely be pretty ugly. Our next bear market will be most likely pretty ugly. So one of the reasons why we call our trade is because we are coming off a historic 10-year bull run, which means the correction will be pretty horrific. Sometimes people ask me, why protect? I protect at the most probable times stocks can drop, i.e. earnings. And again, if you ask me why I really collar trade, it really comes down to this. I work too hard to randomly just let my money go up and down. That's it. You want the real reason why I collar trade? I work too hard to save what I've had in my account. And again, it's not a whole lot, you know, a couple $100,000, 240, 250. I work too hard to just let it go. Not interested in just letting it go. Not interested in letting it go up and down on market whims. Not interested in paying hidden fees or through the nose for a fund or an annuity. Not interested in not having a money manager know my positions or even know what the fund is. Most of these jokers have no clue what's in the fund. But it's an emerging market growth fund, so there's probably some emerging market stuff in it. Again, my personality, I actively choose to attack market problems. Maud and Mary, thank both of you. One of you said amen to that, and one of them said thank you for doing something for me. You're welcome. To be 100% honest with you guys, there are times when, I'll be honest, I don't like my market returns. When maybe I'm behind the market because I'm in something more volatile. But for all the people that have been with me through Disney, we've picked up extra shares. We have leap calls. We're in an amazing position for a November release of their Disney Plus. And man, all that hard work could pay off if it jumped up to $96 pretty quickly. So I'm telling you this not because it's Labor Day weekend, but because a lot of people have asked me most recently, as I picked up some new money, why do I collar trade? Here are the reasons why. And the most important one, I've worked too hard to just randomly let my money go up and down. When it goes down, I want to proactively be making up some of that downward movement. And if at all possible, converting it to shares. So a question, if I know options, why don't I spread trade more? I'll be 100% honest with you. I get pissed off when I lose money in the stock market. I do. I get pissed off. And in spread trading, as you adjust your trends, you always, as your trends change, you always are going to take some type of loss. Yes, you can adjust to lessen the loss, but it doesn't mean you can adjust every trade to profitability. So there are times when I get really frustrated because as a trend changes, and if I'm doing a trade a week, I might go through 3 or 4 weeks where I get my butt handed to me. And if I get my butt handed to me, then that's because nothing more than a trend change where I've got to adjust and give myself time to have my stocks become bearish and to fall far enough for an adjustment that I can try to break even on. So it's interesting. It really is interesting. It's an opportunity to make some pretty good money, but you also have to be considerate that as you go through some trend changes, you could see 3 to 4 of your options just kick your butt. When it comes to emotions, right, Mary? So Mary just said, you hate losing and you have a bad attitude. Mary, I hate losing and I have a bad attitude. You got me. That's exactly right. I do some spread trades, but I do it sparingly. I spread trade within the caller trade. I'm always adjusting after earnings to certain spreads if I can, if it makes sense, if it's fallen enough. But to be 100% honest with you, I don't spread trade a lot because I hate losing and it puts me in a bad mood. And really, it's not fair to my family to do that. If you're going to ask me where our market's going to end this week, we're already down like 180 points in pre-market. I'm going to tell you higher, and that really comes to the fact that we just ended August, and we normally get a little bit of a fund bounce would be the best way to say it. There's a good chance for all the funds that people got out of, we're going to get a fund bounce, which means we probably are going to go test the 50-day simple moving average. And it might not be a bounce higher. It might not just take off higher. I'm not saying that. But we just got our crossover. We're almost crossed over by the 5 and the 20. We're almost there. I would still call us technically bearish, but just barely. Just barely. By tomorrow or Wednesday, we could bounce out of it pretty easily. On the S&P, if I stuck the S&P chart in here as well, and it's funny because some of you might say, well, that chart looks bullish to me, right? Well, looking bullish and actually being bullish are two separate things. And your market's not bullish yet. The S&P 500, kind of an issue. We're bouncing off of the 50-day again. 1, 2, 3, 4 times in the last month. It's been support or resistance. We're not quite bullish, and we also would not quite be bullish on our 5 and our 20. Still technically bearish, and we're going to take a hit because our tariffs still go into effect on China. NASDAQ, I still had them at bearish too. Let me throw that picture in here as well. Come on, come on, come on, come on, come on. And they're more so. Look how flat that line is on the RSI. Not really yet crossed. We're just inching right here. So I'm still calling all the indexes bearish, but I would say that we're probably going to be higher going into the end of the week. And again, the reason why end of the month was last Friday. September is historically down a couple percentage points. I think we'll be down in September as well, but I think it'll be better than August. The reason why I think we'll do better is if you look at the economic reports, not really the earnings. American Eagle, Outfitters, Lulu on Thursday, DocuSign, Kirkland, Genesco on Friday. Not much by way of earnings, but We do have the ADP employment on Thursday and the average work week with non-farm payrolls, you know, kind of some of the stuff that people think are super important, analysts, right? So we're going to have some economic reports that as I take a look at them, will probably boost the end of our week. Being a holiday, it looks like I have not spent enough time on our international. I have nothing for the international economic calendar. And that's really because I haven't looked. So if I take a quick peek, US Labor Day, manufacturing, nothing that stands out. Monetary base year over year, nothing important. On Tuesday, Australia, nothing. Switzerland, European Union, so the PPI, ECB's nominated President Lagarde's speech, we already know how she goes. Not much there. Wednesday, Japan Market Services, Bank of Japan speech, Calvin Services PMI, nothing that's going to move the markets. Bunch of Canada stuff. Japan, capital spending, Japan doesn't move the markets anymore. Thursday, 10-year bond auction, factory orders, Japan, nothing really there. Friday, nothing that I see that stands out to me. Yeah, nothing that I see economically. So I probably could have got by with just saying, hey, good, but always never hurts to check. Never hurts to check to make sure. I found some interesting articles before I get to questions. At least I think they're pretty interesting. 5 reasons to buy shares of Ford. Obviously, the dividend yield is one that they do really well. Forever, they're doubling down on their trucks. That they're taking their most profitable lines and only going to run those from now on. In doing so, they run the risk of higher oil prices. But boy, with the amount of oil coming online for the U.S. and other parts of the world, I'm kind of shocked that oil is where it's at. I would expect oil, in all honesty, to be trading back below $45 a barrel, maybe even down to touch that $30 a barrel. Right now, oil's at 54, Brent's at 57. I could expect to see that down to 45, just the way I think it's going with the glut of oil coming online. Ford's been doing a ton of cost cutting. I like it. Getting rid of its less profitable areas. Autonomous vehicles, they are going into autonomous vehicles. They've lost a ton of money on it, but at least they're looking into the future. And valuation, I mean, it's just too cheap. Way too cheap in general. Way too cheap compared to some of the other car companies that are out there. Just doesn't make sense. Bank of America, the stock will be an alpha beast again. Very interesting. Go ahead and take a look and read through some of the Bank of America statements. I like it. I like where it's going. I like the profitability they could have. So definitely read through. The numbers validate that Bank of America, for all intents and purposes, is undervalued right now. I found an interesting article on turn $100 into $1 million, according to 9 self-made millionaires. And I just gave this to you guys because I kind of did think it was a little bit ridiculous and funny, but I like some of the principles. Invest in something you love. I think you can relate that to the stock market. Buy and sell items from garage sales. I don't know how you become a millionaire from doing that. but the idea of being frugal or trying to find arbitrage, very interesting to be talked about here. Improve and invest in yourself, life lesson there. Learn a high income skill, life lesson there. Write an ebook, I think that's kind of a joke, but you never know. Buy a multi-million-dollar business with other people's money. If you handle the pressure and the stresses, using other people's money is always fun and interesting to do. Build a personal brand. I think this is kind of a joke. Out of the 9 of these, I think this is an absolute joke. So ignore number 7. Start a business on Amazon. I think that does make money. Launch a coaching business. And I think that's kind of a joke too. You need to be an expert in some way, shape, or form, but launch a coaching business and build a personal brand. I can see how they could be helpful, but they're not going to get you money. You need to have something of value behind it. Very interesting article on bonds and the 1930s. It really predicts a big gap in our stock market and a down opportunity where our next crash will be horrific. I agree 100%. Please read through and spend some time looking over it. The opinion is lying about you and Trump's China tariffs. I just found it very interesting. I brought it in here for you guys to read a little bit about the tariffs and how it's working right now. As I went through their numbers, I agree 100%. And tariffs is not hurting us at all right now. A sell first in December can arrive in a week. Analysts is predicting Lehman-like drop. This goes back to the bonds. And again, this is probably a scare tactic in the worst scenario. Again, probably not happening in a week. Just understand that there are some risks out there. And I think it's important to understand or know the complete downside risk that some people could be taking. Disney is on the cheap, full of content and poised for a massive November launch. This is the reason I'm in Disney. Very well explains everything through here, so please feel free to read through that. With that said, questions. And Mary, I know you have a question, so fire it at me. What questions do you guys have? So Mary asked the question, and she actually, I'm glad you're asking it for everyone. I've noticed that most of the time you add shares and then you do not add a protective put again. So the short answer there is yes. That's exactly what I do. How would I do this? Let's use Under Armour. That's probably the most likely one I've done most recently. Under Armour, and I'll put it out to 9 months. So yes, when I added Under Armour, we were at a level that for a couple days we looked okay. So when we added shares, we were adding it right here on this up day, 300 shares, because it held it, it held it, it held it, it held it, it held it. It was resistance, it was resistance, it was resistance, it was the bottom of the gap. So yes, I got into Under Armour and we did not have protective puts in place. We are looking for a rebound, a bounce. And in doing so, I had it unprotected. So from $20.34 down to $19.96, we were unprotected looking for a bounce. looking for a bounce like we got earlier in the year, where we made a great decision to not protect. Well, Kevin, it fell below 20. And when it did, we triggered $20 long puts that are now in place and that are profitable by over $1 on a stock that's trading at $18.61. So yes, I understand that. Well, it was still bearish. Yes, I understand that. And it was also oversold. So I'm not saying I'm always right. But back in May, boy, were we smart. Added 100 shares, maybe took off some puts. Off we went for a run up to 27.50. Put some 27.50s on. I think we actually had some 22s for a while. But yes, I'm going to allow something very important when you're spread trading or trading options. I'm going to allow my stocks to move back up. But we lost like 38 cents. Yes, we did. We lost 1.9% of the value of the stock. Trying to make like another 30% to the upside. I understand. So there are times when I am looking for a bounce. There are times when I'm looking for a bounce because sometimes the bounces can be ginormous. What do I mean by ginormous? Heck of a bounce from 85 up to 140. Now, yes, I had protection on here, and we probably had protection on 1, 2, probably had protection on here. But I didn't add it on the downturn, and I didn't add it on the downturn. In all honesty, I didn't add it from the 142 downturn right here. Another big one that's kind of important, a 165 bounce on Apple. So yes, I did run protection through this point, but we took protection off right here. And then we ran it without protection. Yes, I had protection on for the April earnings, but we went like 6 weeks without protection. And we went from 165 to 200 basically. And yeah, we had like 195 or 200 puts. I think we had 200 puts on it. But yes. Oh my gosh, you ran Apple without protection. Yes. It's how you make your profits. You let the winners run and you protect as they head down. Can support resistance break? Of course they can. And if they do, I will add protection back on like we did for Under Armour. But if it gets above 20, I'm looking to take that protection off again. If it gets down to 1750, I'm looking to take that Under Armour protection off again. I'm going to cash it in. I'm going to let stocks run. So, Mary, interesting question you asked me recently. I think that's very helpful for other people to understand. And it really comes down to don't put bearish positions on a bullish moving stock. It's okay to let some stocks run. So please be okay with letting some stocks run. It's how you get some good gains. Don't need to worry about it. If you're wrong, you can always add the protection back in. All right, what other questions do you guys have? If there aren't any questions, let me wish you guys a happy Labor Day weekend. I appreciate the small group today taking some time and spending it with me. And I don't see anything. There we go. A couple thanks. All right, guys. Hey, have a wonderful, hopefully you had a wonderful weekend. Enjoy a good week going into the future here. Appreciate you guys spending the time with me tonight. Tomorrow night, trade findings and adjustments will most likely be done by Keith Bybee. And you guys have a wonderful evening. Bye-bye.